Good morning. It is Friday, March 5th, and welcome to this special broadcast of the CMT Association. My name is Tyler Wood, and I'm the Managing Director for Global Business Development of the CMT Association. And with me this morning is Stanley Dash, my colleague and charter holder, the Director of the CMT Program. Good morning, Stan.
Good morning, Tyler. Good morning, everyone.
Good morning, everyone. Thank you very much for joining us. I know it has been a wild couple of weeks in the markets, and for those of you who were trading yesterday, hopefully you got off the merry-go-round before losing too much. Let's dive right in because I know
Unless you were short.
unless you were short, in which case, congratulations. And for anybody who is on this broadcast thinking they are attending the Country Music Television Association's broadcast, let me just clarify who we are and what we're here to do. The CMT Association has been advancing the discipline of technical analysis for about 50 years. But what we're focused on is improving investment performance and opening career opportunities. Those are the two main reasons why anybody would care to join the association or go through the CMT program, and we're going to talk a lot more about those outcomes today. We execute that mission through a number of different faculties and areas, and it has been growing substantially. So the CMT Association today has over 5,000 members and affiliates. We have about 35,000 participants in our educational events and offerings. And we have members from 137 countries around the globe. So it's truly an international community of technical analysts, money managers, and traders. And we're glad that you're here to learn a little bit more from us this morning. As I mentioned, that mission that we have to advance the discipline of technical analysis to help people improve investment decision making and open those career opportunities, that falls into a number of categories. And for those of you who maybe aren't in the position right now to sit for 3 very academically rigorous exams, but you're very curious about technical analysis, you want to learn more for your own trading and investing, we welcome you to join the CMT Association. You can join as an affiliate member. There are no prerequisites, and take advantage of a number of the different educational opportunities that we provide as a member-based association. So that's just a quick introduction for where we are and what you're here to learn about today. We're going to talk a lot about the value of the designation, about the CMT program, and what you can learn along the way. 2 quick points that I want to make before I hand it over to Stan. For anybody who is thinking about the CMT program and wants to understand those career opportunities, there are some very important statistics that we just got back from surveys of our recent charter holders. So I want to draw your attention to this graphic on screen about the CMT program. For those who had earned their charter, self-reporting a year later, they found tremendous career benefits. So you see 45% received a promotion, they're in new positions, but I want to draw your attention to this particular statistic about more responsibility. And what that means is that money managers who have earned their CMT gained more assets under management in the year after earning the designation, which means their firms trust their risk management and their ability to capture alpha more than they did before going through the program. Clients as well, they're allocating more capital to these fund managers because they have a trust in their mastery of that body of knowledge that's included in the CMT program. So many more statistics that everybody can go through on their own time in terms of the career outcomes. But for us, that's really telling about the value of the technical discipline and of the CMT charter specifically. For those who are curious about what CMT charter holders do, that's a quick breakdown. It's a very diverse set of individuals, and in fact, one of the reasons why our organization changed its name several years ago. CMT has come to represent members of the financial services industry who have a wide range of responsibilities, including algorithmic coders, program developers for systematic trading solutions, all the way to financial advisors, wealth planners, and everything in between. So we are glad that you're here today, and hopefully you're going to find a lot of value in our presentation about what technical analysis can do for your investment decision making. And I'll be back here at the end to talk a little bit more about what you can learn from the CMT Association and your path to joining the CMT program. So that's our agenda for this morning. We're going to talk a little bit about what technical analysis is, the tools for investment decision making, and then we're going to talk a little bit more about why you should consider the CMT program. And with that, I'd like to bring my colleague Stanley Dash up to talk to us a little bit about the definitions of technical analysis, what it is, and hopefully we'll bust some myths about what it isn't as well. So Stan, I'm going to give you controls and take it away, my friend.
Excellent. Thank you very much, Tyler. Let's see if we have successfully transferred control here. That may not be the case yet.
Let's see here. There you are, Stan. How about now? Wonderful.
All right, I think we're in good shape.
Well
we'll give
done.
it our best. Thanks for your patience. This is a brief introduction of my background. I won't belabor it. You know that when you get a long introduction, it means you're old. But I have been involved in, I started in the business in the commodities area, futures markets, and I've been involved in with the prior, what was known as the MTA and the CMT Association as a member since 2007, and I earned my own CMT charter in 2014. Served on a number of committees of the association, and I encourage you to, as you become involved in the CMT Association, I encourage you to get involved in committees, volunteer, and we do put volunteers to work, but it's a great way to get to know other professionals. It's a great way to have an impact on the association and to have an impact on our industry. The people I've met are, the people who are most vocal and most active. It's just a wonderful opportunity to network within the industry and take advantage of being part of the association. After many years involved in the industry and the association, I did join the staff in 2017. So my current role is the Program Director for the CMT Program. And in that role, I oversee the tests and the curriculum. And I do that hand in hand with an association, with a committee of volunteers, the Curriculum and Test Committee, on which I served previously. And the Curriculum and Test Committee is my my conscience, my second set of eyes, and they bring their experience in the industry to bear, so that between my experience and my hands-on management of the program and their experience and their input, we make sure that the exams and the curriculum stay up to date with the practice of technical analysis, and that the exams and the curriculum actually reflect what a charter holder should need to know to earn that charter. So what I want to talk about for a few minutes, the first item on the agenda that Tyler showed you is what is technical analysis, and that's where I'm going to begin. And actually, I'm going to go through a few slides that have definitions of some basic jargon that we all throw around. I think it's useful for all of us to have the same language. Whenever we're making a presentation or teaching a class, we always want to have the same vocabulary so that we can communicate effectively. And I think, and keep in mind that all of the things that we're going to speak about here are in our curriculum, are part of the exam process, because they're critical parts of technical analysis or built on technical analysis. So let me dig right in. There we go. So first, the definition of technical analysis. So we each have, we at least have the same working definition. There are others, but I try to boil this down to the one most concise, most on target for what we need, and also that would communicate most effectively what technical analysts really look at. The study of price action and market statistics. So we're talking about prices, obviously, are the core of this. They are the center of market action. And by other market statistics, for example, volume, as it says up here, but also we look at things like open interest. We might look at things like short interest. We might look at other trading statistics, volatility, open interest on options. We do all that for one thing primarily, to infer price trends. The other side of inferring a price trend is managing risk. If a technical analyst had to reduce their credo to one thing, it's identify the trend, how can I participate, and how do I know when to exit? Hopefully exit after I've been right about the trend, but if I'm wrong, I also need to exit the position. Identify the trend, participate in the trend, exit. And if those three, if technical analysis helps point the way towards those three, then it's an effective mode of analysis. There are some other definitions that come up here, and they'll give you more perspective. I try to boil it down. Perry Kaufman, who's a well-known author and theoretician and practitioner, and whose material is part of our curriculum, used the phrase systematic evaluation of price volume for the purpose of price forecasting. Another definition came from the esteemed Edwards and McGee. Charles Bassetti has been the editor of the old Edwards and McGee material, study of the action of the market itself. Supply and demand for shares or contracts, and I'll talk a little bit about that in a moment, but we want to stress in that we aren't necessarily talking about, for instance, with equities, we're not necessarily talking about the quality of a company or the quality of its management or its products or the effectiveness of its marketing and sales and distribution. But as technicians, we're going to focus on the shares as the product. What is the supply and demand for the shares for the ownership of that company, supply and demand in the marketplace? We focus on price, volume, and time. There's quite a bit of that in our material, of course, because that's really the essential. And we might want to say that a technician asks, what is happening instead of why is it happening? I don't really need to know why something is rising or falling. Yes, I'm curious, I'm interested, and I want to know the context and the environment in which I'm working. But really what I need to know is what's happening. And am I positioned with the trend, and am I protected if the trend goes the wrong way, or am I in a position to identify when the trend changes? This graphic has been passed down to me, and I kind of liked it, so we put it in here because I thought it was an effective point of dividing the analysis of the company or the valuation of a company from the supply and demand for the stock. So on the top, you'll see the company, and obviously the logo is that of Apple. But we might evaluate, a fundamentalist would evaluate the competition and dividends, products, the management of the company, things I alluded to before. A technician is going to focus on the supply and demand for the stock. That's in the bottom part of the circle. What's the price action? Is the volume showing me where the interest is greatest? What's the supply and demand for the stock? What's the market psychology behind this? How are the news events or the headlines affecting those participants in the market? So our focus as technicians, and not that we ignore the top half of the apple, but our focus as technicians are the things on the bottom, the psychology of the market, the supply and demand for the stock. Now, there are three things I wanted to discuss today. They are core concepts about technical analysis. Oh, I'm sorry. There are a couple of other definition slides. I apologize, I jumped. You'll hear a lot and see a lot in our material and anywhere you look and reference a technician about charts. Some people will speak disparagingly of technical analysis as just chart reading and reading tea leaves and some kind of magic incantation over the charts. But if we want to join the 21st century, think of the chart as your data organization tool. Yes, it is a graphic display, and as humans, we take information in visually. That is, a picture is worth 1,000 words. That is the way we take in information and process it. But more importantly, as we move to a world that's quantitative, as we move to a world where we push a lot of information into computers and ask it to churn out some results, hopefully we have intelligent questions for the computer. Think of the chart as a way of organizing data. So from the traditional bar charts, line charts, candlestick charts, point and figure charts, those are just ways of organizing a time series. The time series is the market data coming at us a mile a minute. That is a way of organizing it historically and currently. And then we can analyze that data because now it's some organized fashion. So we do learn all this. We need to learn this, and we need to know and understand this in order to be able to move forward with deeper analysis, even if it is not visual, even if it's not discretionary, even if it moves to the the quantitative, which we'll discuss in a moment. I seem not to have control here, Tyler. Would you click down? Just give it one click. There should be one bullet at a time that opens up.
You got it.
Perfect.
How about now?
I'll try again in a moment. We look at the data for price patterns. You know, in fact, you can open up the next bullet if my keyboard doesn't seem to be responding.
Sure. I'm sorry about that, Stan.
That's okay.
The next bullet I think you have
behavioral finance, because price patterns and behavioral finance go hand in hand. Behavioral finance, of course, has become something very prominent these days. A lot of Nobel Prizes have been won in the field, and it is important. And as someone who was involved in the industry before that was a common phrase, we always knew that technical analysis was about gauging the psychology of the market. We'll see one tool today, we won't delve into it in depth, an RSI indicator, for example, or other momentum indicators that are really telling me, we know intuitively that if a market goes up and up and up and up, somewhere in there's going to be a down day.
Mm-hmm.
Well, why is that? Because at some point, people are going to say, look, I've got a lot on the table now. There's a behavioral finance aspect. We see that in the price patterns, and that's why I wanted to see those two bullets at the same time. And there's quite a bit about this in all of the material. Everything I'm covering here is in our text and is questioned on our exams. But this is what's behind technical analysis. There's there are the flows of supply and demand. They form price patterns. How do I organize that data? How do I see that time series? I do it with charts, even if the chart is just a jumping off point to a computerized analysis. Other things we cover are things like Dow theory. I don't know that I pressed the button, it seemed to work. is Dow theory. And Dow theory is some of the origins of, at least of Western technical analysis, are in Dow theory. And we cover that in our text. And yes, we're referring to Charles Dow, and the founder of Dow Jones at some point. And he was one of the first ones to use gauges of equity prices to estimate the strength or weakness, or the coming strength or weakness in the economy. And that was a jumping off point for a lot of technical analysis that we do today. And finally, other things we'll see in technical analysis, and we'll see some today, are indicators. I want to make this point about indicators, which do not seem to be happening for my keyboard at the moment.
Stan, I'm sorry, buddy.
That's okay. I've done worse.
Okay, we're good. I'll drive for you.
Sometimes I work without a net or an internet. Indicators derive from price and volume. We all amateurs will look at different indicators, whether it's something common like a moving average, something a little more exotic like a stochastic oscillator, something even further on than that. They're derived from price and volume. What's the point of indicators? The point, if we make the indicator too fine, it's just a replication of the market. The point of an indicator is that it's going to skim away some of the noise so we can see the signal. So I see the market coming at me. If I can just read the market as it is, well, that's great. But there's a lot of noise, there's a lot of buzz that's coming around that price action, that time series data. So the indicators we use, and we obviously cover them extensively in our material, the indicators that we use are designed to help us focus in on what's relevant about all that price and volume and open interest in other market data that's coming at us. Something as simple as a moving average is meant to say, well, I don't want to look at all those swings. Can I get some idea? Can I get something that culls those away and just shows me what's the trend? Mm-hmm. Keep that in mind with indicators, and we're going to take a look at a few indicators as we go through this today. One or two more slides on definitions, because these are important and it confuses people. We talk about quantitative analysis. Is that technical analysis? Is one a subset of the other? I don't know. We could probably spend hours debating that. But I found what I felt was a useful definition of quantitative analysis, using complex mathematical and statistical modeling, measurement and research, assigning a numerical value to variables to replicate reality mathematically. I thought that was a very useful definition. As you can see, that quantitative analysis, my opinion, quantitative analysis when it comes to markets is something that in some sense is built on technical analysis. This is what we did when I started in the business with pencil and paper. This is what we did in calculating moving averages by hand every night. This is what we did by drawing trend lines on a chart. Those are perhaps older crafts. We still teach them, and I still think they have value, but then we jump into the quantitative. This is what I was alluding to when I was talking about charts and organizing data. If I want to do some quantitative analysis on the price time series coming at me, I have to have some way to organize it. Whether I look at it visually, actually look at it and make a subjective analysis, or whether I just push that data into some formula for analysis. So I had once described years ago at a conference, number of years ago already, I described quantitative analysis as what happened when they gave technical analysts computers. Because now we could actually crunch that data in unlimited ways. I did a lot of this by hand and when I was a young man, and then as we began to get desktop computers and mainframe time, we began to really stretch our limits on what we could do. So quantitative analysis, I think I see it as an extension of technical analysis. That may be a little bit of my bias, but it is certainly related. Mm-hmm. And I think that learning the basics and learning where technical analysis comes from leads you to the quantitative, and it is things we touch on in quite a bit of our curriculum. Okay. One more
it's interesting.
Definitional slide. Tyler, please.
It's fascinating to me, Stan, that the big data revolution now has a lot of money managers looking at low aerial satellite footage on Walmart parking lots to see if they're going to beat earnings based on estimations of the traffic in their store. And yet, if you back up 150 years, Charles Dow was reading empirical evidence of what was happening in the market and came to the conclusion that the industrial manufacturing companies might just be adding to their own inventory. They might be reporting that there's been a lot of new goods sold, but unless you get a confirmation from the transport index, you know that those goods aren't actually getting out to customers. So right. I find it kind of cute that the discipline of technical analysis was doing big data analytics in the late 1880s, and we certainly have come a long way in terms of computing power, but the concept really originated a long time ago.
I would parse that a little bit further and say that analysis of traffic in the parking lot is fundamental.
Yes,
100%. I don't really want to analyze that data, but I want to see what action occurs in the marketplace based on the people analyzing that. So I used to say this in somewhat more glib fashion. I don't want to do the meteorological study. I want to look outside and see if everybody's carrying umbrellas with them or not. Exactly. If they're all carrying umbrellas, I want to get on the ride.
There you go.
I'll know I need.
Walter Deaver was our guest on the podcast that came out this morning, and his famous saying is, "I watch their feet, not their mouths." Story's not as important as where they're putting money to work. Sorry to interrupt you, Stan. I'll let you get right back into it.
No, quite all right. I'm going to try and go to the next slide. I guess that worked. Okay. One other definition, and then I want to get into 3 points, and I want to keep this moving and respect your time. Algorithmic trading. We hear that phrase a lot too, and this is related. So I put up a definition of algorithm so we'd have a common vocabulary. A step-by-step procedure to solve logical and mathematical problems. A lot of work I've done in the past has been around systems development, trading systems, back testing them, putting them into automation. And we always had this problem of, we had been doing that for many years before it became fashionable to call it algorithmic trading. We used to call it system trading or strategy trading, back testing, automation. So I would define, and I'm doing this for your own sake, and we're not going to really discuss it in that much detail here. Algorithmic trading to me breaks down into 2 very broad categories. What I did when I said I developed systems and back tested them and automated them, that was really algorithmic decision making, the second of the 2 bullet points on the screen. Knowing when to buy and sell based on some algorithm, based on some historical repetition, based on an attempt to gain some statistical edge. Nothing will be 100%, but if it gives me some reasonable edge in the long run, I come out ahead. Mm-hmm. There is something also known as the algorithmic order placement and order management. That might be the classic example of that is a fund that wants to accumulate 500,000 shares and has some algorithm for going after those shares. In other words, they will time slice. They will buy a certain number in every time period, or they will work against the VWAP, the volume weighted average price, or they will in some other way have an algorithm that helps them accumulate those 500,000. So that algorithm is not making the decision to own the stock. That algorithm is making decisions, or is a decision tree for accumulating the position that they already decided to take.
Mm-hmm.
So we'll hear algorithmic trading in both those senses. We cover in our material, we cover the second of those two, frankly, more than order placement and management. Order placement and management is I think apart from the technical analysis aspect, although we do have discussions in there of VWAP, the volume weighted average price, and how that's used in order placement and management. But our focus as technicians and in the CMT is more the second of those two algorithmic trading concepts: trading systems, trading system development, and backtesting. So there are three core topics to technical analysis that I'd like to discuss this morning. As I said, I tend to go on a bit, so I'm going to try and stay on track here. They are all covered in our material, and they are basic to technical analysis, whether you become part of the CMT program or not. And I have a few charts, of course, to show you as an example. One is relative strength, the other is breadth, and the third one is divergence. Those three concepts are a main part of technical analysis, and we'll talk about them in here. In fact, Tyler alluded to divergence, although we'll look at it in a little different method. Relative strength, a technical concept that measures the relationship between two securities. One security is divided by another. We're saying which one is stronger. Is this stock stronger than this stock? Is this stock outpacing its peers? So how is it compared to an ETF or an index of its industry, or an ETF or an index of its similar market cap issues? A technical concept that measures the relationship between two securities. The simplest way to do this is a ratio, one security divided by another. Relative strength can be used to better understand an intermarket relationship. It could be one stock against another. But as I said, in other cases, it's one market segment against another, or stock against the rest of its segment. It's really any two data streams, any two time series, any two symbols that you'd want to compare. So I put up a chart, and this was just from a few days ago, as of a few days ago, and I used two ETFs, IWM, which is the Russell 2000, and SPY, obviously the S&P 500 ETF. So we could take a look at comparing those. Now we can compare those visually. We can see this covers the period just prior to a year ago, prior to the period when the pandemic became such a problem for all of us, and that hard break, and then the climb back out that we've seen for the past year. But it's hard to evaluate from this, hard to evaluate mathematically, which one was relatively stronger than the other. And as I quoted from Pring and in any other material, the basic idea is divide one by the other. Divide IWM by SPY, price for price. And that gives us an RS line, a relative strength line, and that's the red line that you can see at the bottom of the chart. Now we see that the break, I don't know if you can see my pointer, but before the break that we had last fall in March, do I have a pointer on here? You can't see mine, I guess.
No, I'll drive for you.
Okay, you're in the right spot.
IWM.
Anybody car sick, you're in the right spot. Stay right there.
You got it.
Before the break that happened last March, if you go straight down to the RS line, to that same area, now down to RS, down to there you go, you'll see that was already weakening. In other words, before the big break, it was telling us, well, IWM is weakening compared to SPY. How would I have repositioned? Well, leave that one alone for the moment. We had that break last March, everything fell, but we see by the RS line that Russell 2000, the broader market, got hit, or the smaller caps got hit much harder. Now, when that bottom was being made last March, we see that relative strength began to go sideways. So the thought was, well, okay, maybe we're beginning to come out of this, and maybe Russell 2000 is going to lead this a little bit. The reason I dropped that trend line across there, that green trend line that Tyler's helping me by pointing to, is because we can do trend analysis on relative strength. And that's why I put that line in, because look, it was not easy to buy that bottom. I know some people who were very bullish at that bottom. I know people who were bullish before that bottom and had some rough days and nights. And I know some of us maybe were later to that bottom. That's all part of it, of identifying a trend and managing the risk. And we all have to do that a little bit differently, either for ourselves or according to a client mandate. But notice that trend line gave us plenty of other opportunities to enter into the Russell 2000, or to overweight Russell 2000 or overweight smaller caps even before this last run. That relative strength showed and steadied and held its support quite nicely even before this last run. We're going to look at IWM and a couple of other contexts as we move along. That's a daily, and as I said, that goes back roughly a year and a half, the entire period that's in that chart. Relative strength. Now, the challenge with relative strength, click back up a minute if you can.
Shoot, you got it.
The challenge with relative strength is I'm looking at two data sets. How can I look at a third? You'll notice that on the extreme right of the chart, where we have the scales, have IWM, SPY, and then the scale for the relative strength ratio is blank. And it's not because it doesn't have numbers, it's because the numbers don't mean anything. If I have a stock that's 1,500 and I'm comparing it to the Dow, which is at 30-something thousand, it's a number. So what means something in relative strength is the trend. Is one thing stronger than another, and is it getting more stronger? Not the best English, but is it getting increasingly strong? Or is it still stronger than another, but now beginning to fade? So how can I look at multiple symbols, and how can I see something dynamic, like the RS line, which is giving me trend? How can I see that across multiple symbols? Now you can scroll down, and we can take a look at something called a relative rotation graph. This is a relatively new invention in technical analysis. The person who created these is a contemporary of ours, and it was a tremendous amount of work on his part and others' part, but it's really had an impact on how we think about relative strength. So instead of just comparing one symbol to another, we're comparing multiple symbols, or we can compare multiple symbols to a base symbol, a home symbol, a core symbol, a one denominator. So each of these ETFs is being compared to SPY. You don't see SPY up there, but I'm telling you that when I made these charts just a few days ago. So these are different market segments, generally by their capitalization, all compared to the SPY. Now the jumping off point is, if you can see the one that's dark blue, it says IWM out near the end of the arrow. So if you follow the trail, you'd follow it from left to right if you were looking at this. You can see IWM doing better. Now this doesn't mean it's doing worse, but this means it's not improving how well it's doing. The idea of the rotation is what's leading and what's lagging, and what's getting better and getting worse. So that upper right quadrant, and I move the origin out of the direct middle. You can see where the origin is right there, but I moved it to the side just so you could see better. So you can see IWM is still in that leading quadrant, upper right, northeast. It's still leading, but now it's telling me it's not continuing its lead quite as strongly. And the idea, as these move around the origin, and they do not move around perfectly, but you can see the trail for this. This is approximately, I think in the chart, I went back to last fall. So it's approximately 6 months, 5 or 6 months that's in here. You can see how that rotation is. Now, there's a lot of talk at the moment about value overtaking growth. And if you take a look right near the origin, you'll see IVE. Now, it may be a little hard to tell, but I'll tell you that IVE, that's the one, exactly. IVE. So IVE moved from the improving, it was on the lagging side, but improving. Now it moved into leading. Stumbled a little bit, but it's still in that leading, and now it's a bit early maybe, but moving in terms of improving and leading.
Mm-hmm.
Will value be more prime? Will value have relative strength compared to growth? That's a lot of the discussion going on amongst money managers now. It seems to be evident, and the relative rotation graph is giving that kind of picture. Some of these others are different capitalization areas, but I just wanted to point out those two because we looked at IWM, and IVE, or value, is something that's really a big topic of discussion right at the moment.
Mm-hmm.
Relative strength is one of the concepts we cover in depth, and one of the concepts that's core to technical analysis. It's sometimes referred to as momentum. I think that kind of confuses the issue a little bit, just because I get stuck on nomenclature. The teacher in me gets stuck on nomenclature. So I prefer not to use momentum as a synonym for relative strength, because we have other tools that are momentum oriented. But the momentum of relative strength is very important, and it's carried on for decades and decades as a useful and viable concept in money management and sector rotation.
Mm-hmm.
Are you ready
to tackle breadth now that we've all had our morning coffee?
Yep.
There's a D in there.
The good thing about a webinar.
That's right.
So breadth, go ahead and put the definition up, please.
You got it.
There we go. When we talk about breadth, we're talking about the stocks within an index or the stocks within a market. That's what breadth is about. If you're a futures trader, you really don't look at this concept of breadth. If you are a Forex trader, you don't look at this concept of breadth. The concept of relative strength applies in other asset classes as well, but breadth is really for equities. Measures the imbalance between advancing and declining stocks. A net increase in the index, more issues declining, should generate concern that the upwards move, while a net increase in the index, in other words, if a stock index is rising but the breadth is falling, should be of concern. It means a relatively few issues are pushing that index up. Remember, an index, whether it's market cap or price weighted, is calculated from its components. So if there are thousands of components and the index is rising, but only a small proportion of those thousands of components are pushing the index up, something internally is showing weakness. A net increase in the index while issues are declining should generate concern that the upwards move is poorly supported. That's a great definition of breadth. Take a look at the next slide. Oh, actually, there's one more bullet on here, which is my koan.
Mm-hmm.
Okay. In the old days, we used to say, is it a stock market or a market of stocks? So if you're going to look at just the Dow Industrials or the S&P 500 or the Russell 2000, you're looking at that as you're looking at the index as a stock market. It is a market. It is an item itself.
Mm-hmm.
Or is that really just the sum? Is it a market of stocks? Is that the sum of its components? And breadth is about breaking that down. Breadth is about understanding that that index is just a calculated number from the components. What's going on inside? What's going on inside? So take a look at the next slide now. Thank you, Tyler, for.
Of course. I think about market breadth like championship teams. You tend to not just have one really great player. If you look at the Bulls of the 90s, it wasn't just Jordan. He had a very solid team around him in order to win all those championships. That's breadth. Well said.
Well said. We look at a team batting average, being a baseball fan, and we know that if it could be skewed by Mike Trout.
Yeah, I don't talk about the Knicks with you, do I?
I don't know. That could be different this year. Here's a chart with an example of breadth. Now there's IWM again. I thought we'd stay focused on that because it was interesting and we were able to bring the theme through a number of the presentations. So that's a weekly of the Russell 2000 ETF. So that goes back about 2 years or so. A weekly of the Russell 2000 ETF, and that's the advanced decline line. It's simply the advancing issues every week minus the declining issues every week. If you look at the far right, you'll notice I didn't put a scale up there. It doesn't matter. The number is the number. What you're interested in is the trend. What you're interested in is how does it match up with price. Now, if you look at the red arrows I put on there, the red arrow is right before the market broke last March. So we were still in pretty good shape, not punching to a new high. Remember, those are only weekly. So that was February, March. You may have been long, many of us were, and pretty comfortable. But look what was already happening to the breadth. That red arrow on the breadth line is at the same point in time. Breadth had already been weakening. Now, from the time the breadth made its high, IWM still made new highs. So if you had bailed out just on breadth rolling over, you might have been out a little early. And I'm not suggesting that. I'm suggesting it's a piece of the perspective. It's part of the jigsaw puzzle of what's making up that market. But you can see quite clearly breadth was not holding up well at all, and that was well before the break. Look at the green arrows. Again, what happened at the bottom? I couldn't resist drawing that green trend line because you've got a head and shoulders in the advanced decline line, so I just couldn't resist drawing that. But those green arrows match up in time. So I don't know what's going on at the bottom. Let me look at breadth. Well, breadth is really recovering. Not only is it's recovering significantly, it's making new highs, it tested its lows, and even if I'm a little late, notice the trend line. Even if I was late by a couple of months, and now it's out in October, that we were testing that red trend line on the breadth line, the AD line, and I had plenty of chances to say, you know, this is holding. That's a third test of that area, and it's a shot at going into the market. Price always rules. Price is more important, but this is giving me additional perspective.
Yeah, trend following investors don't typically pick bottoms, certainly not absolute bottoms or absolute tops. They're looking to capture long-term trends. And so, Stan, I think you made an excellent point, which is that there are multiple signals telling you that conditions are constructive and improving. You referenced the resistance line becoming support, and that bouncing off of this support line tells you a confirmation that the trend is healthy enough for the advanced decline line to continue to improve. It did not crash back below that support line, and of course, the story tells itself in terms of what has happened to small cap.
Yeah, I didn't put any trend lines or anything else on the price data itself. I left that as it is because we just wanted to chat about AD line. So it has to fit in. Your AD line is never going to be your prime signal.
Right.
But if this is testing a trend line that I think is valid, or if I have a signal based on some other momentum oscillators or moving averages or something else that is, or the candlesticks themselves, does it fit in with that picture? It could even be a fundamental reason. It could be that I'm following the economy and the underlying index, and I see that this segment is going to do better, and I see capital rotating there. Well, how can I time that? The support line, that red support line in the AD line, advanced decline line, is pointing out spots at which I might have a lower risk entry or be able to add to something based on an exogenous signal of some kind or some other technical signal.
Brilliant.
We can go on to the last piece, and it kind of ties some of this together because it will allude to some of this. There's a concept of divergence in technical analysis. Tyler, I said, alluded to it much earlier today. Confirmation and divergence were things that were talked about in Dow's writing and in his protege's writings, in terms of, well, if the industrial average is rising, back in Dow's day, 100 plus years ago, then companies are manufacturing, we're expecting earnings, but are the railroads rising? The railroads would be rising if they're shipping the goods to market. So you look for confirmation, and then sometimes you'll hear the word non-confirmation, you'll hear the word divergence. Here's the idea for an indicator, and we'll leave Dow aside and come back to the 21st century. We said that indicators are calculations we make from price, volume, breadth is an example of an indicator as well, from market analysis. And the idea is separating signal from noise. I mentioned that earlier. So an indicator is only good for me if it indicates. And if it indicates what the market, if it gives me clarity on what the market is doing, or helps me with a probability or an edge about what the market will do. So divergence analysis is looking at indicators to see, are they confirming what the price action is doing, or am I seeing a yellow light, a warning signal of some kind? I think there's one more piece on this slide. So the technical analyst asks the question this way: does the indicator confirm the price action? When you study, and I get this from students all the time, because bullish and bearish divergences and positive and negative divergences and double divergences, and it gets very confusing because there are so many phrases thrown around, so much jargon. When I look at the chart, and I remind students, just look at, does that indicator confirm the price action? If the price action is bullish, and that's primary, price action is always primary. But is the indicator confirming it, or is the indicator saying, yeah, price action is what it is, but why isn't the indicator confirming that price action? That's what the heart of divergence analysis is about. So if you click over to the next slide, we have one more chart to look at to talk about this idea of divergence. And after this, then I'll turn it back to you, Tyler. Here again, I put up the Russell, and it's a weekly again, so you're looking at about 2 years of Russell data. And of course, the events a year ago and then the subsequent rally have been dramatic and have been in front of us so much the last couple of years. Who even talks about 2008 anymore? You'll notice that small red trend line on the Russell. So the Russell, it's almost horizontal. At the beginning of that line, there was a new high made, then not a new high made. It's borderline in there, but I want to make a point. At that point, looking at the chart, you had no reason to be a bear. Just looking at price action. It was kind of sideways for a number of weeks, but you had no reason to really be a bear. Well, take a look at that first indicator below that. And before I even describe it, just look at it at the pattern, and I'll tell you what the indicator itself is. You'll see that it notably, and I did match those up, those do cover the same time periods. Notably, that indicator made a distinctly lower low, a distinctly lower high, and was beginning to fade out. So even though price action was pretty consistent poking at those highs, I was not getting anything out of it. And even if you just use your eye to go a week or two later before the biggest part of the break, boy, that indicator was really not doing well. It was well off its highs as we started that break. Same thing for the indicator below it. I put the same 2 points on there, and it was breaking very hard early. Even if you don't look at the whole break, you'll see that, boy, this is just not confirming any price action. That apparent bullishness up at the top is not happening. Now, I want to tell you what the two indicators are. The first one is actually a breadth indicator. It's the number of issues in the Russell 2000 that are above their long-term moving average. So technical analysts have taken a technical indicator, a moving average, and turned it into a breadth indicator by looking at how many stocks in an index or on a marketplace are above or below that moving average. So it becomes a breadth indicator. In this case, we're looking at how many issues in the Russell 2000 are above their long-term moving average, which would be bullish. Obviously, the rest are below, or a few could be equal. And the bottom one is a momentum indicator, pure price. It's a relative strength index, RSI. Do not confuse it with the relative strength we discussed earlier. It's a momentum indicator, but it's based purely on the price of the asset, purely on the price of the IWM weekly chart. So it uses no outside data. It doesn't use breadth. It doesn't use volume. It doesn't use any other information outside the price. And they're both showing divergence at the same time. They're both showing weakness. They're both showing early failure when the Russell prices were still holding strong. Now they both turned also, of course, off that bottom. Well, the reason I put the question marks in there, and I made this about a week ago, is what now? The market's lower than where it was when I made this. It hasn't really broken the uptrend, but the market's lower. I think we closed yesterday at about 223 on the IWM. I don't have that open in front of me, but we are somewhat lower. You can see how flat that breadth indicator is. and you can see how flat that momentum indicator is.
Mhm.
One thing I would note, if you look at the breadth indicator, I just can't resist this, I'm sorry. I said it's how many in the Russell 2000 are above their 200-day. So I have a quick pop quiz. I'm not really going to put it up. What's the maximum that could be? How many issues in the Russell 2000 at the maximum could be above their 200-day average? Well, for argument's sake, let's say 2000.
Yep.
So that was coming across at over 1700. So at some point you're pegging the indicator. At some point you're pinning it.
Mhm.
So it's been very flat up there because there will always be some issues not participating in a rally or in a decline. So you'll
There's a
see how
reason there are
flat
some
that
penny
becomes up
stocks,
at
right?
that point. Go ahead, I'm sorry.
There's a reason there are some penny stocks, right, Stan?
Yeah, exactly. It's one of the reasons, by the way, that most analysts don't do breadth analysis on the Dow Industrials. It's 30 stocks.
Right.
It doesn't, the sample size is too small for breadth analysis. It's not useless. It's interesting, macro analysis, but still, when you start to get a greater sample size, at least the S&P 500, now you've got 500 issues, so you start to get a better picture. So this has been flat, and we have in the past week seen some sell-off in IWM, though the trend is not broken. And that's why I put the question marks up there. Keep an eye on it. I don't know what's going to happen either. I just think those are warning signs that we may start to show divergences in the indicators versus IWM. So a couple of things. I've talked about a number of items, and I want to make sure that we understand. I've said it a few times. It's worth repeating again. Price, price, price. Then there's everything else. And the other things that we use should add color, should give us more information about the price action, should cull away noise so we can get to signal. Other things should give us perspective like breadth, divergence analysis, and of course we talked about relative strength to compare sectors and to compare indexes and to compare securities. This is at the heart of technical analysis, and these are covered extensively in our material, of course, and we test on them, of course, because they are important for a chartered market technician to understand and to know these things. No one, even a CMT charter holder, will necessarily have every formula in their head all the time.
Mm-hmm.
We don't have to these days, fortunately, but we do have to understand the tools and understand the precepts, the principles that go behind it. First principles, we might say. What helps me see and understand the market better? And that's going to be different for a futures trader it's going to vary some between a futures trader, forex trader, equities trader. A lot of the tools will be the same, but some will be different.
Mm-hmm.
All of that is in our material. And for those of you who gave me your time today, I thank you. Tyler's going to take it over. We hope you'll get involved in the CMT program and start studying for the next exams.
Thank you so much, Stan. I really can't state enough just how central these tools are to successfully managing risk and finding returns in the market. And I know 2020 has brought a new generation of participants. And so I know we're speaking to some of those folks this morning, as well as the institutional brokering houses that are working with those new traders. So if you're a product manager at Robinhood or TD Ameritrade, these are probably some of the investor education tools that are going to be needed for this next generation to not lose their hat, so to say. I know George Soros was famous for having said, "It's not about how much you make; it's about how much you don't lose." And I think, in particular, the concept of divergence and these signals as market internals and understanding when the situation for risk on investing or risk off investing is changing. So thank you very much, Stan. And in the last couple of minutes, I'll just wrap up with a few logistics for those of you who would like to anchor your trading in CMT program knowledge. All right, so we've talked about the CMT program, a little bit around the edges, a little bit about what is covered. The basics are that it is a 3-level exam. We offer those exams twice a year in June and December. and it is a globally recognized credential. And that's the main and most important point. You can learn technical analysis, but this is an organized course of study covering the candidate body of knowledge that Stan and the CTC, the Curriculum Development Committee, have determined is the most relevant to chartered market technicians today. And they've called that information from speaking with hiring managers and the charter holder community to find out what tools, concepts, and skills are most important for the job market today. So it's very much designed around the practice analysis from our members. So 3 levels. You must complete those exams in sequence, and you may only take 1 level of exam per administration. So if you were to start today, the next exam cycle is in June of 2021. June 3rd through the 13th is the exam window. Pick a date in there. You would start with level 1. Assuming you're successful at each level, you would take level 2 in December, and you'd be done with level 3 and become a charter holder next June. So a full year is the fastest that you can complete that program. All right, we talked a little bit at the beginning about the value of the CMT designation. For those of you who joined us late, we do survey our members, and on a self-reported basis, new charter holders have talked extensively about the new opportunities that came to them after completing their CMT program studies and earning the charter. I just want to point out that in addition to promotions and new jobs and new roles, that greater responsibility statistic is really important. That means they have more assets under management after earning the CMT charter. So for those of you who are perhaps not managing your own hedge fund right now, but you are developing your discipline, your signal strength, your edge in the markets, if you wanted to take that money management practice and go public, CMT designation is a step in that right direction to establish the trust and the competence both with firms and with clients. All right, so let's dive right through these last 2. We did talk a lot about breadth, divergence, and relative strength today, but overarching for the curriculum as a whole, we want to talk about at least these 4 main key topic areas of risk management, quantitative systems development, design, testing, you name it. It's all conducted in the context of a portfolio management discipline. And then we do talk a lot about applied behavioral finance. I know we could spend hours discussing Kahneman and Tversky's work. We can talk a lot about all of these traits that have evolved with human beings over the years and that do make the markets not purely rational. News alert, we're not all rational human beings. And so when we get into the marketplace, we do things like our anchoring bias attaches us to certain prices and big round numbers. The herding principle, we just call it price momentum that people pile into trades. So you'll learn a lot more about that through the CMT program, which is central to the work of financial advisors and understanding that their clients might be most enthusiastic at market tops, where there's very, very high risk and very little to be gained, and totally pessimistic at market bottoms, like we had at the end of March 1 year ago. And so your job as a armchair psychologist might be to help them understand in a more rational and objective way what the markets are telling them. All right, for those of you who are interested in sitting for the exams, a couple quick announcements. The coronavirus pandemic has affected the CMT Association, as it has affected all industries, but we've adapted, as we always do. So the CMT exams are also offered not just through Prometric test centers around the globe, but also through Prometric's remote proctoring capacity. So you could sit in a home office or take the exam from work. There are a lot of requirements in terms of the system, the Wi-Fi strength for you to sit for the exam, as well as the exam security. So currently this morning, I would not be able to take the exams with a bunch of books on my desk. That would be illegal. But I encourage all of you to head to cmtassociation.org and find out a lot more information about that remote proctoring process. Through the work of many, many individuals, we have also consolidated the curriculum and made the course of study much easier for candidates. It used to be, as it has been for many other charters in the financial industry, a stack of books, all great books, but multiple chapters from each of those, and sometimes redundant information, occasionally contradictory information. And so Stan and the CTC and the team of experts, subject matter experts, have put together a curated textbook at each level. We publish that through John Wiley and Sons, and you can head to their website, efficientlearning.com/CMT, to get your copy of the 2021 curriculum. They also have ebook versions and test banks and other materials that the Wiley team has developed, but you will find the official CMT curriculum there as well. For those of you who are interested, they have shared a discount code, which we're happy to share with you as well. You can take 30% off of your curriculum purchase using that code CMTTW30. All right, last couple of announcements. I want to respect everybody's time as we head into the US market open. As Stan talked about, the CMT program is really a practical course of study. We want you to understand these tools because we're not theoretical meteorologists. We want to know when everybody's carrying umbrellas and it might be raining outside. As part of that practicum study, candidates in the CMT program are given access to a very robust, very powerful set of not just charting, but also backtesting and quantitative tools through a company called Optima. We really appreciate their generosity in this partnership, and it's been a great part of the CMT program for years. As candidates are going through and reading the official curriculum, they also have a chance to apply these tools, roll up their sleeves, and learn in the Optima charting platform. So that is multiple thousands of dollars of value every year for candidates. While you are studying, you have free access to the Optima tools. One more announcement. I know we have investors all over the world who are assessing their own toolbox and looking at their risk management discipline, their sell discipline, and we have seen fundamental analysts thriving to learn more about technicals in these last several years, and certainly a return to volatility as we've seen in 2020 and currently in 2021 is driving a lot of that trend. So through a partnership with the CFA Institute, wanted to reach out to all of you who are CFA charter holders in good standing. You are able to enter the CMT program and begin testing at level 2. You're still responsible for all of the subject matter covered in level 1, but Stan and the team had done a robust curriculum mapping process, understanding that a lot of the same topics were covered through the 3 levels of the CFA program that were covered on our level 1. So CFA charter holders are exempt from the level 1 exam. You can begin testing at level 2. And we encourage all of those who have a strong fundamental discipline for stock selection to also think about that chart of Apple that Stan showed. For a real complete view on the market, you need to, of course, understand the company, but also understand what's happening to the shares of that company. You don't have to take my word for it. There are many dual CFA CMT charter holders. You can head right to our website, cmtassociation.org, learn more about that CFA waiver and hear from dual charter holders about how they fuse or combine multiple disciplines into their investment management practice. After all, our objective is to improve investment decision making and open those career opportunities. So by all means, check out those testimonials on our site and learn from them. Just to summarize, I know we've covered a lot this morning. There have been a lot of positive changes for the CMT program, and that's what's driving a lot of our global growth. We've talked about that simplified membership. There are no prerequisite requirements for CMT program candidates. This program is designed for both current and aspiring professionals. We have a lot of university students who are mastering at least the first level before they leave college or university, and that gives them a real leg up in the industry in terms of understanding how markets actually work. We've talked about the remote proctoring and the consolidated curriculum for your course of study, as well as the expanded opportunities for education and access. Again, as we said at the outset, if you're just here to learn more about technical analysis, if the exam portion of this is not for you yet, by all means, we welcome you to join the CMT Association as an affiliate member and take advantage of all of the educational offerings, the webinars, the journal publishing, the conferences and events. And as we are trend following investors, I thought it might be appropriate to share with all of you that you would be getting in on a very bullish trend. This is just a chart of CMT program registrants. We were at all-time highs again last winter, and we invite all of you to join us and join that global community of CMT charter holders. So to get started, again, the exams are June 3rd through the 13th of 2021. We really appreciate your time this morning coming to join us, and we encourage you to head to cmtassociation.org to register, both enroll in the program and then register for your individual exam. And thank you so much for listening this morning. For those of you who are ready to register, we wanted to offer you a $100 discount on your registration just for coming this morning, and that code is J21CFA100. So we look forward to your questions as you're going through the course of study. By all means, reach out to Stan and I. It's pretty simple. I am Tyler at cmtassociation.org, and Stanley is Stan at cmtassociation.org. We look forward to hearing from you, and thank you again for joining us this morning.
Thanks, Tyler. Thanks, everyone.
Thank you, Stan. We'll talk to you soon.
You bet.